This lecture will help you keep more of your stock portfolio's returns. We'll look at transactions cost and taxes. Along with diversification, minimizing taxes and transactions costs are the easiest ways to increase that third variable that everyone wants to maximize on their investment returns, the rate of return. Diversifying is easy compared to minimizing transactions costs and taxes. You'll remember from Lecture 5 that you can get most of the benefits of diversification by holding a random selection of 15, 18 different stocks, so long as you don't put too much money into any one of them. What's more, intermediaries like mutual funds let you get even more diversification than that on the cheap. Minimizing your transactions costs is a little harder. Still, you can do yourself a big favor by doing nothing. That's right. The best way to reduce your transactions costs is to trade your stocks only when you have a really good reason. A hot tip from your brother-in-law doesn't count as a good reason. You probably know that, but you probably don't realize just how much of a difference transactions costs can make over the long haul. Professors Brad Barber and Terence O'Dean's famous paper in the journal Finance in 2000 got the attention of money managers and investors around the world. The professors studied the trading patterns of over 62,000 households and individual investors with discount brokerage accounts, no-frills accounts that let people buy and sell stocks for reduced fees. What they found isn't pretty. These investors trade an average of more than 75% of their stocks in their portfolios each year, 3 out of 4. What's more, these investors were paying high trading costs on those trades. The professors calculated the costs of round-trip trades, or buying today and selling later. They found that round-trip trades involving more than $1,000 cost 3% in commissions, plus 1% in bid-ask spreads. The magnitude is lower these days because transactions costs have fallen, but the point of Barber and O'Dean's paper is the same. The more you trade, the worse you do. Period. End of story. The relationship between your trading frequency and your stock returns is strong. Barber and O'Dean grouped the 62,000 households and individual investors into 5 equal-sized groups based on how often they traded. The low turnover group traded much less than once a month. Their gross portfolio returns, that is, before trading costs, were almost exactly equal to the returns on the S&P 500. Because they traded so little, their net returns were almost exactly equal to the return on a low-cost mutual fund invested in the S&P 500. That makes sense because they were following pretty much the same investment strategy as the fund. As the amount of trading increased across the 5 groups, the average gross return was virtually unchanged. The returns net of transactions costs, though, dropped consistently across the 5 groups as the investors traded more. In the group with the highest turnover, trading costs ate up about 1/3 of the gross returns. Investors who traded the most surrendered 6 or 7 percentage points every year. That's an enormous sum. Forfeiting even 2 percentage points of annual return can just hammer you over time. I'll give you a numerical example to illustrate. Suppose 10 years ago you invested $10,000 and earned a gross return of 8% annually. If you incurred about 0.2% in transactions costs per year, that's index fund territory, then you'd have $21,193 today. If instead you were a moderately active trader and incurred 2% in costs annually, then you'd only have $17,908. That's over $3,000 less. Over 20 years, the gap becomes almost $13,000.